Hello and welcome to Idea.IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. K&L Gates is a fully integrated global law firm with over 40 offices on 5 different continents and close to 2,000 attorneys. Today's topic is how to position your startup for venture capital funding. We're going to get started with the slides in just a few moments. But before we do, I want to provide you with a little bit of background for today's event. I'll be running all of the tech in the background, so if I need to pause to work on it, please bear with me. Additionally, today's event is being recorded. I will follow up with you in about a week, maybe less, with the recording. So if you miss some or all of it, don't worry, you'll get to check it out. Additionally, if you're not watching live, if you're watching a recording, welcome. Glad to have you here too. Now, another note in terms of it being recorded and also it being a public event, please don't provide any confidential information, whether in communication in the chat box or in any of your questions. It's not an appropriate venue for that. Now, additionally, feel free to use the chat box. The chat will be used amongst yourselves. I'm not going to be monitoring the chat. If you've got a question, I encourage you to ask it. Please use the Q&A function. I'll be monitoring those. I'm going to speak for about an hour, then we'll take any residual questions that we don't cover during my talk. And that'll be, I'll reserve about a half hour for that after speaking. Now I am going to move through, and as we move through this content, I want to pause and take some topical Q&A. And then if there are any other miscellaneous questions, we'll save those towards the end. I think that with that in mind, only other plug is to, again, fill out the audience survey. It's great to know who's here in the room today. Frequently find that it's dominated by people in this time zone, but there are a lot of folks who view it time shifted. And again, we're happy to have you here. All right, let's get going on how to position your startup for venture capital funding. This presentation is really primarily focused on letting you know what the well-worn path is for venture-backed companies. And I think it's a great conversation. Now, today's discussion is providing you with general information. I'll share with you some of the law that is applicable, especially here in the US and in particular California and or maybe Delaware. But that law may or may not apply. In applying the law to circumstances, we need to know those circumstances. We need to know all the facts, and sometimes there are exceptions or exemptions from those laws. So an off-the-cuff answer or a description today is not necessarily the right answer for you. You need to retain competent counsel to review all the facts and circumstances and then provide you with advice. And that caveat holds true in today's discussion. And if we have a conversation, I do keep office hours, typically Fridays at 2. If you're, in or around my time zone, which is the Pacific time zone, because I'm based in San Francisco, California, we can accommodate you then. If you're outside that time zone, I'm sure we can find a time to work you in the schedule. Another interesting thing actually is that I've been working on a project. It's in beta, sort of a limited confidential test. So those folks who are here today are viewing. If you're open and interested, if you think this content is helpful, you can check out sort of a similar but different set of content that I'm working on. Love your feedback on it. Again, it's general advice, not legal advice specific for your information. All right, so here's an overview of today's discussion. We're going to cover my background so you can understand why I am talking about the things that I'm talking about today. We'll talk about structural considerations, right? We're going to go through that well-worn path. I'm going to sort of describe on how to get to where you're going. One of my favorite things to do is to work backwards, okay? So understand what your set of objectives are and then get the things in place that you need to get you there. So we'll talk about entity form. We'll talk about sort of typical financing stages. We'll talk about, a lot of the foundational stuff. We're not going to go in deep depth today because we don't have time for that. But we're going to view it at a high level, kind of get your feet wet a little bit. I think it's good. We'll talk about an overview of safes and convertible debt. You'll understand why that applies in this context. And then we'll talk about valuation and dilution, and we'll give you a little bit of an overview or a preview of venture capital financings, what they're like. And then we'll talk about common pitfalls, and then we'll hit any additional questions that you got. Let's get started. All right. So as I mentioned before, I'm a venture capital and emerging growth company attorney. So that means I work with venture-backed companies, those that desire to be venture-backed, and also investors as they deploy their capital into those companies. I've been practicing law since 2005. Wow. My office is in San Francisco, California, but I work with companies throughout the world. Now, that's one of the unique things about this platform is that we have offices on 5 different continents in many major tech and venture hubs. So that allows us to collaborate, and then being based in the Bay Area, tech and venture usually at some form or other, if you're at a large company or a company that's scaling to be a large company or a company that desires to scale to be a large company, you're going to touch the Bay Area at some point. So that's usually where my point of entry is. I love working with entrepreneurs and executives as outside counsel on financings and exits. I actually started my own law firm and ran that for about 5 years. So I know what it's like to start from scratch with no customers or clients in my case, and then build a business. And I think that experience makes me a much better attorney and practitioner as it comes to meeting and solving my clients' needs. Let's keep rolling. All right, so let's see who's in this room. And share the results. Got 25% from the Bay Area. Nice turnout. Got a lot of folks in from the US. So it looks like a bulk of the US today. And then a few others from North America and Europe. Welcome. And then, as is very common, we have about 30% first-time entrepreneurs, 30% in early stage companies, and then got a few serial entrepreneurs, few growth stage companies. We have some venture investors, some folks in academia, and then we've got some folks who do other things. Let's get rolling. All right. So structural considerations. If you want to be a venture-backed company, let's talk about the common structure. Now, we're not talking about every single case, but probably 90 to 95% of the cases, especially here in the United States. Okay. And whether you're a venture-backed company or a non-venture-backed company, we apply the same matrix in trying to figure out what's the right way to structure your company. And I'm going to say these things in non-specific order because it's going to depend on your particular business as to which is more important than the others. But taxes. Is it an optimal tax structure both now and as the company grows and scales? Liability protection. If you're just a sole proprietorship or a partnership, you potentially have unlimited liability exposure on your personal assets, your car, your house, your cash, et cetera. So typically want to have some liability shield and protection in place. Think about what the ownership structure is going to be and what kind of equity grants you may need to give or provide to your employees, right? That's a bit of the model of these growth companies is that, employees don't necessarily take as much cash up front, but they get equity and they're incented and aligned with the company to grow and to do a good job. What your capital raising requirements are going to be, right? Do you only need $100,000 to build this business to maturity? Or are you going to need $100 million or $200 million or $10 million or $5 million? And we ask these questions in a very non-judgmental way. Okay, not every company should be venture-backed. Actually, most companies should not be venture-backed. Venture financing is a means to an end, a means to building a specific kind or applying a specific business model. We think about management requirements. How is this company going to be run? Okay, are the investors going to want to have a seat at the table or a board seat? And we think about the exit. What's the time horizon for the exit? Is it 3 years? Is it 1 year? Is it 5 years? As I will quickly touch on, we'll touch on that in a minute. As we'll touch on, there's a particular time horizon that venture investors are typically interested in. And we'll talk about a regulatory framework. Now, some businesses cannot be set up as C corporations. And C corporation refers to corporation for tax purposes, which is a separate entity, versus an S corporation, which is a pass-through entity, or an LLC, which is typically also disregarded, or a pass-through entity. It's taxed more like a partnership. And Yes. So regulatory framework matters. Sometimes you can't have a corporation. Sometimes you need to, or sometimes if you're going to have somebody run the business, it's going to need to have a special license. So we see this sometimes with telehealth and other sort of companies in either healthcare or sometimes in the finance space. You know, some of these spaces where there's highly regulated, it's going to matter. And what we see is when we take a look at that matrix or that framework, for the vast majority, it's going to push them is to be, for the vast majority, it to be Delaware C-Corps, if you're talking about a US startup, for companies that are going to be venture-backed. Now, venture-backed companies, we're talking about companies that are going to grow and scale rapidly. They're going to raise successive rounds of capital, as you can see here in this slide. First, they'll probably start out with some seed funding to get their initial prototype together, maybe get their initial sales, put the initial team in place. And then, you know, there are going to be inflection points in the company where they'll raise money, they'll build out something. Maybe they'll build out the sales team or they'll build out additional product. And then they'll get to a point, hopefully they will hit their targets or matrix and they'll go out and raise some more. That's what we're talking about here. And we're typically talking about in a 5 to 7 year horizon, time horizon from when that venture money comes in, not necessarily the seed or angel money, but the venture money. Sometimes it's a little bit different for other sort of niches within it, like within venture, like life sciences, et cetera. But that's what we're generally speaking about today. And what pushes it for a Delaware C-Corp is typically the investors, okay? They want Delaware because the vast majority of companies that are publicly traded are Delaware corporations. That's typically the sort of gold standard exit, you know, that after that sort of 7-year investment period, they get liquidity with an IPO. That's the gold standard in terms of kind of what everybody's usually shooting for at the outset. The reality is many, if not most, well, most of the successful exits are actually M&A exits. But still, what's pushing it for Delaware is that's where you're headed. Generally better protections for liability protections for directors and officers for a host of reasons, which we won't necessarily go into from here at this point. And yeah, that's what's pushing it. Sometimes I get the question of, what if I've got an LLC that I set myself up with? Is my life over? And the answer is, you know, probably not. You know, certainly there is a way to convert or merge over or somehow otherwise get the business into a proper form for venture investors. The question is timing. When does that happen? And also, can you get the requisite consent of all the stakeholders, all your other LLC members that you may need to go out and get? So, you know, that's going to just depend on the facts and circumstances of your particular business and who else is kind of on your cap table, your capitalization table. That is who's got an ownership interest in it. And, you know, whether or not you'll get their assent. Maybe I'll pause here, see if there are any questions. Oh, we got a question, a really good question, actually. If you haven't broken even, VC is not right for you. Did I read that correctly? Well, it's going to depend on your particular industry and your particular business. Life sciences companies, which actually can't get a product to market till they clear FDA approval, or, you know, they've gone down the right path for whether they're a medical device or whether they're a drug and kind of what kind of regulatory clearance, different beast. For most true venture capitalists, as opposed to angels or maybe even venture micro VCs, micro venture funds, they're going to want to see revenue. It may or may not cover your expenses, but they're going to want to see it kind of hockey sticking up. So yeah, so most of the time they're going to want to see you at or getting close to being able to break even, or at least having a story where they can see kind of what the path is on that. So you're going to need to get revenue. Do hedge funds raise as Delaware C-Corps? So I'm not in the asset management group, but by and large, my understanding is most funds, whether they're hedge funds, venture funds, private equity funds, I believe that they set up as limited partnerships or LLCs, not C-Corps. And that going into that is way beyond the scope of today's conversation. But I will note, because it is related, because VC funds are set up as limited partnerships, that is, they are passed through for tax purposes. That's what drives the VCs to want to have a company that is a C-Corp, that is a standalone entity for tax purposes, so that the profits and losses are not passed through to the fund, which would then need to pass them through to its investors, which would result in a tax accounting nightmare, because venture-backed companies typically are running losses for a very long period of time, which also kind of brings it to that question, like, do you need to break even? No, not necessarily, but there needs to be real traction, pull, real revenue growth. Typically, again, not in all cases, but that's typically because especially what the early VCs are looking for is product market fit, and they're using revenue, and especially revenue that is growing at an accelerating rate, to determine, yes, there is product market fit. What really matters is that this company is going to explode in a good way if we can give them the capital they need to scale, to add those other things in place, and it will kind of continue hockey stick up. Founder and early employee documentation. Again, all of this is focused on how to get your startup to a venture capital financing. That means getting it set up correctly. That means getting the intellectual property into the company, okay? Sometimes I get questions from founders, well, can I just keep it, or can I license it into the company? And the answer is going to be typically no. Every once in a while, you can kind of get away with it, but there needs to be a really good business reason for that, that the investors can see, yeah, you're actually still all in on this. And it makes business sense for you to keep either license into the company or get a license out of the company. Vesting. So vesting refers to making sure that you've properly secured the ownership interests of the founders and early employees in this case. And the issue here is, if somebody is fully vested, that is, if they just outright own their shares of stock, and this is like sort of a pause and parenthetical, common stock is the ownership interest, or represents the ownership interest in the company. If people own that outright and then they leave, they get to keep that stock. And one of the problems here is you may have a situation where somebody's only kind of put in, I don't know, a month, 2 months of time, and they've got a third of the company. And it doesn't make for the correct economics, and it can be difficult to fix. So the way to get ahead of that issue is to make sure that the stock is subject to vesting. I think vesting is a little bit, or at least the common understanding of vesting is a little bit of a misnomer. People sort of think of vesting as, well, you get your shares kind of over time. But I think sort of the better way to look at this or think about it is that you actually get all of your stock at that point in time. You've got the voting rights, you got all that, but it's got strings attached to it. So as time goes by, the string gets cut, and the string gets cut again. And that happens. And so I'm talking primarily about restricted stock for early employees and founders. Options are also subject to vesting, but typically you don't get those into place until, you've got some funding, even if some limited funding like seed funding. And transfer restrictions. So this is about having a little bit of control for that cap table, that capitalization table, that, basically a chart that says who owns what in the company. And, you want to make sure that folks can't dispose of this in a way that's going to be detrimental to the company and the rest of the stakeholders, right? Like selling shares to a competitor, let's just say. So you want to give the company the opportunity maybe to repurchase that stock, or maybe sell it to the, or if the company doesn't want it, assign that right to someone else. And that these transfer restrictions will occur in shareholder agreements. They'll occur in restrictions in the bylaws and or in stock purchase agreements. Let me just click back Actually, let me take a pause, see if there are any questions. And if not, I'll give you just a real quick plug again. If you are, find this content interesting and you want to check out sort of a beta version of something I'm running a very limited test on for a limited time at no cost, you can check out Venture Capital Training Camp. It's up to you. Hope to see you at camp. Anyway, let me click back here. Let's talk about seed funding. So we're talking about this initial space here where you'll raise from angels, friends, and family for seed capital, which gets you your initial prototype and or initial team together. So typically, we're going to see convertible debt or convertible equity raise. Now, in common parlance and what is common these days, convertible equity is really a safe note, which is a simple agreement for a future equity. It's basically all the stuff that a convertible debt is, except for the debt feature. So there's no money to repay at a maturity date, and there's no interest rate. That's kind of like the main difference. Convertible debt's also sometimes called bridge notes. Bridge means kind of get you from one place to the other. So get you from the spot where you are to your venture financing. Now, that was certainly pretty true in the early 2000s, in the 2000s and the aughts and maybe even in the early 10s. But in these days, we're seeing companies raise successive rounds of bridge financing and capital. So you might have a couple convertible debt or safe rounds. Typically, when we're talking about the amount of money that's being raised here, it's in the millions. In the Bay Area, we are seeing a lot of sort of larger convertible debt, convertible note raise, or safe raises. Could be $5 million, $10 million. Some companies have raised, I think, maybe even up to 20 million. It's sort of dependent on your investors versus a venture round, which is what we really think of when we think of like a venture financing, a preferred stock financing. And in those venture rounds, the first ones are typically called either Series Seed or Series A. And, we're seeing larger and larger Series Seed and Series A rounds, especially for the Bay Area, typically 5 million and up. Probably makes sense if it's, maybe 7 or 10. But outside the Bay Area, they can be a bit smaller. The reason what sort of drives some of this, we'll talk about this in a second. Well, there are a couple of reasons that drive it. Let's talk about it. So the purpose of convertible securities is to convert the money that you put in to equity, that is the preferred stock at some future time, and you get a discount. Basically the money gets a boost so that, it accounts for the risk that investor has taken. Now, the advantages to this is it avoids valuing the company. Okay, the problem or the concern about valuing the company, if you're an entrepreneur, is if you undervalue the company, then you've sold too much of the company. If you've overvalued the company, then from the investor's perspective, they've not bought enough of it. The reason why this kind of works out in these instances is that the expense sort of with doing a preferred stock raise, especially if you're kind of using the NVCA forms, the National Venture Capital Association, by the time you move through diligence and you've sort of done everything, they're very expensive. And folks would much rather spend the money on product and team than on legal. And so, there are still reps. There is some diligence that is done with safe and convertible note rounds, but it's usually far less, and they can get expensive. They can get negotiated for far less. And the thought process is, well, when the round is large enough for everyone to do real diligence and also for there to be a better sense for product market fit, right? That is seeing that revenue, seeing that growth, then that's a great time to maybe assign an initial value to the company. Now, downside, at least for convertible notes from a company's perspective, is that it's debt and it may need to get repaid at some point. Additionally, because it's debt, if the company goes under, or there's some sort of other liquidity event or liquidation event, then the debt holders get paid back first. So that would be before the founders would. Upside, I guess, from the investor's perspective, well, you got a little bit more security. These are usually still unsecured notes. And let's talk a little bit about their terms. I mentioned maturity date. That's the date that you got to pay it back. Interest rate, think about your credit card. Interest is going to accrue. You usually not paying cash over time. It's going to accrue. So the interest rate kind of typically will function as like a boost to a discount. And then conversion terms. And we'll run through like a real quick and dirty example of conversion of how the conversion terms actually apply. So you'll get to see that. Amendment terms, I always focus on this, especially, the old form of SAFE didn't have this, which I always modified. New form of SAFE is a little bit better, but you want a mechanism so that if you have to go out to each SAFE or convertible note holder, you don't want to have to do that. You want to be able to go out there and get a majority in interest of that. And then for SAFEs, it's not common to negotiate too many more terms. There are usually always a couple tweaks that people do, including myself. And then for convertible notes, there's no standard. There's no real standard. For a while, I thought 500 startups was they had a really popular form, but I don't know. It seems to be a little bit less common these days. All right. Mandatory conversion terms. So this is when sort of the rubber meets the road. When there is an event, typically a Series C or Series A preferred stock financing of a certain size, and this is something that gets negotiated. Well, then that's the time when everybody, that's the time when the note or the SAFE will convert over into preferred stock. And it will convert over at a discount. Now, what we're typically seeing is 20 to 25%. There's also a concept of caps, and we'll talk about those, and I'll give you a quick and dirty example of how those apply. But caps, in sum, basically says if the pre-money valuation of the new money, that is what the new investors, the preferred or venture investors are putting in, is greater than the cap, we'll ignore it in figuring out how many shares the convertible note or SAFE is going to convert into. Don't panic. Again, I've got an example, and then also in the venture capital training camp, which I mentioned before, and I've got a link in here. I actually kind of break it down with some Excel sheets for those of you who are super into Excel. Conversion upon a change of control. Sometimes we see that in there, and optional maturity conversion. So that's basically and this is something that's kind of investor protection, right? If the note hits maturity, something's got to happen. The company's got to pay the money back in theory, but many times the money's been spent for development. So one of two things happen. Either you get sort of the requisite consent to extend the note, that is, extend the maturity date, or if there's optional maturity conversion in there, then perhaps the note converts into either common stock, or if there is some kind of preferred stock outstanding at that point in time. So let's kind of, I do a much longer SAFE and convertible note talk. This is not that talk, but let's just kind of run through what these concepts are and put some numbers on them. So pre-money valuation is the value of the company before the money basically comes in connection with a round. And most of the time when we're talking about this, we're talking about it in the connection in the context of that venture capital round. Post-money valuation is the value of the company after the money comes in. So usually to get the post-money, you take the pre-money valuation, you add the money that comes in, and that's your post-money. Pretty simple equation. One other concept that you need to understand is what a fully diluted basis is. I'm going to give you a definition today, same with the other two definitions. This is kind of what is commonly used, but there's not really a true standard. So you got to read the fine print on all this. But the sort of context, or excuse me, the sort of crux of what a fully diluted basis is it's basically all common stock that is issued and outstanding. So we're not talking about what is authorized in the charter. That's the maximum number of shares that the company could issue. We're talking about what has actually been issued. Now, hopefully you have not issued more stock than you have authorized. Otherwise, you got a corporate cleanup problem that you got to deal with. And then you also have to add all the securities that can be converted into common stock. So safes, convertible notes, options. Typically also the equity pool will be included in this definition. So kind of with that very simple explanation, let me give you a very, very simple example, not factoring in things like any other equity that's outstanding or option pool that's out there. If you had a company that the investors deemed to be worth $10 million on a pre-money basis, and that was split, and there were 10 million shares issued and outstanding, split among the three founders, and the investors were to put in $3 million. Well, to figure out what price they would pay for acquiring their $3 million of shares, you take the pre-money valuation and divide it by the fully diluted basis. So 10 divided by 10 is $1 a share. $10 million divided by 10 million shares is $1 a share. So they put in their $3 million and get 3 million shares. And so you can then see the dilution that founder A or a founder will take, right? Whether it's A, B, or C. They still have all the shares that they started out with, the 3,333,333. But the denominator has changed. There are now no longer 10 million shares that are issued and outstanding. There are 13 million. So you can see they've kind of dropped down to 25%. But, at the outset, when they got their 3 million shares, they probably paid very, very little. Effectively, it might have been worth like nothing. And so you can see how, at least on paper, the value of their equity has tangibly increased, right? Because there's been an arm's length negotiated deal. Like the company is actually worth that. Someone's willing to pay $3 million to get, that share of the company. Now, let's ignore some circular math, ignore some options, and just kind of try and do this on a quick and dirty basis. If there had been, let's say, a bunch of convertible securities out there worth $450,000 with a 25% discount, and let's just keep even that for whatever reason, the numbers worked out that the new money is paying $1 a share. Well, if you got a 25% discount, you take, you take what the investors would be paying and you apply that 25% discount, right? So that works out. So instead of $1 a share, they'll be paying 75 cents a share, which means that they're going to get 600,000 shadow series or shares of shadow series. A shadow series means they get preferred stock, and it has all the rights and attributes of what the new money is getting, except for some adjustments because the economics are not the same. They're not the same because they're getting those shares at a discount. They're not paying $1 a share. They're paying 75 cents a share. And so that shows up in liquidation preference and dividends and maybe another anti-dilution rights, something like that. Now, with the concept of a cap, let's take this here. So if there had been $450,000 and there was only a cap on this safe or convertible note here, well, you would see actually that those investors would end up with a total of 900,000 shares because they got $450,000 invested. And then rather than, in terms of calculating the per share conversion price, instead of using the $10 million divided by 10 million shares and applying a discount, we're just going to pretend it's $5 million. The value of the company is just $5 million. And they divide that by the 10 million shares. So they're actually converting at 50 cents a share. Now, many times safes and convertible notes will have these two things together. And so the investor will get the better deal. Many times there's sort of like a common pitfall is people think, well, as soon as the pre-money valuation goes over the cap applies, the discount doesn't apply. But actually, because of the way the math works out, that's not right. I think the math is basically you take the discount and you take the cap and divide by the discount, and that's the tipping point. But that's neither here nor there for the purpose of today's conversation. So let me just zoom out for a second tell you once again why we're talking about this. So we're talking about how to position your company for a venture-backed, for venture financings. So we're talking about setting you up right and getting you capitalized in a way that is plain vanilla that the venture investors are going to understand. Now, again, not all companies should be venture-backed. Vast majority should not be venture-backed. But if you've got a path where your company is going to grow and scale rapidly, it could end up being worth hundreds and hundreds of millions, or more likely even billions of dollars within a 5 to 7 year range of time. And you're going to need to raise a lot of capital, tens to hundreds of millions of dollars. Then that model is what the venture model is typically sort of designed for. If you've got a business that doesn't meet those requirements, doesn't mean it's a bad business. It just means that venture capital is probably not right for you. And if you are headed down a venture capital path, most of the time, and again, we do the analysis every time, because although, I don't know, 90, 95%, maybe 98%, Delaware C-Corps are the way to go, it's not really truly true every single time. So we do the analysis every time. But getting it set up right, the fundamentals of having intellectual property going to the company, having ownership interests being clearly staked out, whether they're founders, employees, or those initial investors, right? And the initial investors was a well-worn path for how to capitalize these for the seed fundings, for raising that first $5 million, first $10 million using safes or convertible notes. That's why we're talking about, because that's what your investors will typically expect to see. And if they don't see that, you may end up having to spend a lot of money to clean it up. And it might deter financing. So any questions? Oh, good. We got a couple questions. Okay. Someone asked if most companies shouldn't be venture-backed. How do you know if yours should? Hopefully you've seen that I've answered that question. You can check it out again on the replay at sort of around the 36-minute mark when I send it to you. But quick recap, got to have that exit. 5 to 7 years, got to grow, scale a company that's going to be worth hundreds of millions, if not in the billions range, and need to raise a lot of capital in order to do that. Worry about okay, so we've got a question about my worry about assigning intellectual property, a U.S. patent, to a very young company is, what if the company fails out of debt due to debt obligations? I lose my IP. Why not grant a partial assignment commensurate to the value of the company or my shares that are vested? Well, so again, we're talking generalities today. That may or may not be the right path for you, but what we typically see, if you're going to want to have venture investors or even sophisticated angels investing in your company, they're going to want to see that the company can secure its intellectual property. Okay. So that's going to mean typically that the company owns it, so that, if you start in, I don't know, 3 years later, the company started to scale, but I don't know, something happens. You get hit by a bus, let's say. Okay. Then the investors know that the IP is in the company and they're not going to have to duke it out with your estate, let's just say. And so, yeah, maybe you can get away with that kind of initially, but once you start getting sophisticated investors, they're going to be probing on this issue. So the usual right answer is just get it all in there. It shows you're all in, basically. Oops, don't want to click on that button. All right. So we've talked about the path to get you up to venture financing. Let's talk about what venture financings are. So at this point, you've got a credible business plan put together with milestones. So if you go back and you think about the chart in terms of like what financings look like, you've actually thought through and put together. It doesn't necessarily need to be like a formal 10-page business plan, but you've thought through and put together how much money the company's going to need to raise and scale, what the inflection points are going to be, and how much money you're going to need to raise at each of those inflection points. And that's going to need to be shared with the investors, because they're going to be looking for those investors. That is, the venture funds also have investors, and their investors are looking for a return on their capital. Venture funds are typically focused on having a few really big winners that are going to double or triple in value every 2 years, 3 years, or 18 months, 2 years, 30 months or so. And so that's kind of their model. So you gotta fit in there, and you got to have a credible business plan that fits into the model, the venture model. So they can think, yes, we want to make an investment in you and put you in our portfolio. And then ideally, what you're going to want to do is run a very systematic process. So raising capital, whether it's seed or venture capital, is very much a sales process. You are selling a piece of your company. Now, when you're doing a preferred stock financing, it's in one sense a little more clear because you know exactly how much the percent of the company is going to be sold and how much you'll have afterwards. Not as true using safes or convertible notes because those babies convert at some point and you don't know how many shares they're going to convert into. But make no mistake, you're selling a piece of your company. So what are you going to do? You're going to want to connect with the right investors. So those are typically, from a company's perspective, those are going to be investors that understand your business, understand the model, hopefully even have access to customers, suppliers, talent, other things like that, that are going to be good partners, good partners for the next 5 to 7+ years as you grow and scale this thing. You want to understand your ideal term sheet. And we'll talk briefly in the next slide about what the key components in a term sheet are going to be. But again, work backwards. Think about, at this stage, what is it that you want to get and put that together so that you can hopefully go out there and hit it and achieve it. Or if you can't, maybe you do a market check and you realize, you know what, there's no way that I'm going to get someone to, value my company and my Series seed financing at $500 million. Well, it's good to know that. Okay. You got to do that market check maybe. Prepare for thorough diligence. So unlike a safer convertible note round where, they may check out your cap table, they may take a look at sort of your IP investing, IP assignment agreements, investing agreements. Venture capital rounds, you got to be prepared for a thorough diligence. So that means they probably take a look at all of your agreements. They're going to ask to look at all your agreements. It's going to get put in a data room, and a data room is just a fancy way of saying, basically like a Dropbox account, either many times we will host the data room for our clients, but it's basically just think of like Dropbox or Box where all your documents will be there and sort of ordered and listed, and they will go through all of them. And be prepared for some cleanup. Okay. Like everybody in this space understands that you got to be scrappy at the beginning. And money typically goes to product and talent ahead of legal, especially at the very early stages. So there's going to probably be some cleanup, and it's going to cost you some money, but hopefully at least the value, the value that you are going to be able to, the value that we would add and the sort of perception of it or the impact of it is timed well in connection with that venture round, right? In other words, and another way of saying that is, you could spend a whole lot of money on legal at the beginning, and if your company dies because you can't sell product or there's some issue with it, like although there was sort of value add by legal, you haven't really gotten a chance to realize it. A little bit different in connection with the financing. So I got a few other notes here. Let me just take a look at them. Now let's go back and talk about the business plan just for another moment. You have to be able to articulate your market and your go-to-market strategy for your business. Okay. I don't know what your business is as we sit here and we talk today, but you need to be able to put that together. And you need to also, as I mentioned before, be able to articulate your capital requirements and time frame for doing that. And then understand the risks to your plan, okay? Because that's what the investors are going to be looking at. The investors are looking on return for their capital. So they think about, great, what can the upside be? And what are the things that are going to keep us from getting to that upside, right? So market risk, is their product market fit, right? One of the ways they sort of, especially for most venture funds in the space, early ones, is there that product market fit? Are you showing customer pull to keep signing up for your products? And what's holding you back is not that they don't like your product, but man, you just can't get enough engineers to build out the back ends, right? Something like that. Understand your regulatory risk, okay? Many times venture plays involve some kind of shakeup or disruption in the market, whether you are sort of the first ride sharing company, or I don't know if it's the first one, but if you're like kind of a ride sharing company and there's always some sort of entrenched regulatory scheme or framework, understand what that is, because they're going to probe on it. It may or may not turn on what your play is. They don't necessarily at the early stage expect you to be compliant fully compliant under the regulatory scheme, but they want to see, yeah, I know that's out there, and here's how we're going to address this issue kind of once we get some money to grow and scale and take care of it, Make sure you understand like what the technology risk is, right? Can you actually build this in a time horizon that's going to work in 5 to 7 years, right? If you are working on, I kind of don't want to name it because there's so many things these days that I have no idea if they're going to hit or not. But, and I don't want to sort of denigrate anything. But let's just say you were going to be working on a product that involves space tourists to Neptune. Okay. Probably not going to be able to make that happen in 5 to 7 years. Okay. So you got to understand also the technology risk, because the technology isn't there. It's just not there. And it's not probably going to get developed within that 5 to 7 years. So those types of issues, not being able to, the technology isn't there, or it won't be able to be commercialized within the time frame. And again, it's a little bit different. Some funds, maybe it's more like a 10 to 12 year horizon. Some plays like in the life sciences play, like they understand these things take more time. But, if you're truly off by decades, it's just not going to work. It's just not a fit. And then run that systematic process. Okay. Investors are people, whether they're angel investors or venture investors. So know your audience, know what they're interested in, do your homework, look them up on Crunchbase, look them up on PitchBook, go to their website. Many of them will articulate what they are interested in, and make sure they're a fit. Now, if you can, try and figure out what other investments they've made. A lot of that's available online for little or no money. You may not want to go to somebody who's invested in a competitor. You may want to go to somebody who's invested in a complementary company. They might be very interested, and they might be able to see some synergies there. Build a relationship before you need to ask. Now, this is also important from a securities law perspective too, but build a relationship before you need to make a money ask. It'll help get you past the trust factor. Investors, again, are human. Yeah. Know that there are different investors out there. So I've already mentioned some of them, right? There are angel investors, which are folks who've, wealthy individuals who've got money, who are maybe interested in investing in your startup, either because they know the space or they want to support it, right? That's very common these days, I think, in either sort of the life sciences and or energy and climate. There are groups of angels called bands of angels. There are incubators and accelerators. There are venture capital funds, which we talked about. There are also strategics. Those are companies that are operating companies that play in this space, and they've got different motivations. Doesn't mean that you shouldn't work with them, but you just understand what they are and make sure that the time horizon is all aligned for everybody. Sometimes strategics are motivated because they want to help seed the need for their product, right? If they make widgets, they want there to be more companies that they put their widgets in. Other times they're looking for access to talent, or they want to be able to kind of maintain their market position. So those are just all different plays. Doesn't hurt, especially once you kind of get into negotiation or discussions, or you might, get past the first stage, to do some diligence, do more extensive diligence on VCs. Maybe talk to some companies in their portfolio or some that have exited. How did it go? How did it go when it was tough? Think about those things. I got a question, and then we're going to move on to ideal term sheet. Okay, so we have somebody with a physical product already being produced. They anticipate being profitable on day one. Would they be a venture capital fit? VC money will be primarily used for marketing production of quantities of product. So again, the typical VC model is 5 to 7 years. They want to have an exit, M&A exit or IPO exit. They're building a portfolio, I don't know, 25, 50 companies, sort of depends on their thesis. They got to have like a 3x return. They're looking for companies that are going to sort of double or triple every 18 to sort of 30 months or so on their way out, so they can get the multiple they need by only having 1 or 2 winners out of their 1 or 2 or 3, just a handful of winners out of their portfolio. So if you can get them the return that they need, which, if you're sort of first round in, exit 7 years later, could be 15x, 25x. I've heard some VCs say 100x. If you've got that, if you hit that model, then then you could be a fit. I mean, one way to do it, as I said, is to just start to research who you might want to contact and see what they're interested in, and you can do a market check on it. That's what I would suggest. If you kind of think you hit that model, do a market check and see if you got some appetite for it. But if you don't need venture capital funding and you can scale the business the way you want, then do it. And the other thing too is, like, there are other players, right? There's like private equity, and there's like growth equity, and sometimes those folks might be interested in it. They've got a little bit different time horizon, and or they may have some synergistic other portfolio companies. So, if you can build a company that is scaling, and especially if it is profitable, you will find investors. Investors will be looking for you. They will start knocking on your door. Especially these days, more and more investors are actually doing outbound outreach, trying to actually get those companies in their portfolio. So hopefully I answered your question. Let's talk about some of the terms that are typically on a term sheet. And then I want to move on to kind of what the process is. And I've kind of spent a lot of time. So let's see here. All right, typical terms in a venture capital term sheet. No need to hide the ball. If you want to kind of give a sense for what a venture capital term sheet is, you can go to, it's nvca.org, the National Venture Capital Association. Look at their documents. They've got a form, a term sheet. I will tell you, most of the time I see, even if we're doing an NVCA style deal, I don't see that particular term sheet specifically being used, but it's pretty similar. It's close enough to give you a sense for what's there. Shoot, I don't remember. It's maybe 12 pages, something like that. And you can contrast that with, you go to like the seriesseed.com and you can check out what that style. These are kind of two different ends of the spectrum. And again, even though seriesseed.com does seed financings, the word seed financing is used for all different things these days, and seed preferred stock is used for a whole bunch of different stuff. So don't get too hung up on it. Typically, especially for an NVCA style deal, how much of the company is being sold, what price, what the dividend rate is going to be, which is typically 4 to 8%, liquidation preferences, which are typically sort of 1x or non-participating. I have other talks in Venture Capital Training Camp. We go into all this stuff in more detail. So I'm not going to spend a whole lot of time on it because we're just talking about how to get to venture capital financing today. Voting rights. So, do the preferred vote along with the common on what things do they vote? Do they have any sort of blocking provisions, in terms of like if there's going to be a sale of the company, do they have a blocking right? Those gets to the protective provisions. Under what circumstances does the preferred stock change into common stock? So we're talking about optional and mandatory conversion. Anti-dilution protection. So that means, what if the company doesn't go up, but instead it goes either is basically flat or down at the next rounds? How do those folks get topped up? Typically, we're talking about broad-based weighted anti-dilution. Who's going to be drafting? How much of the investors' attorney's fees are going to get covered? Don't let them be uncapped if you're the company. No shop, so that basically you can't go out and shop the term sheet, and whether the investors will get a board seat. Those are the things that get negotiated. Work with your counsel to kind of get a sense for what's market and kind of what's your ideal. And then, that way you can position yourself when you're having these initial discussions and conversations. So the process is pre-term sheet work. You're kind of going out, building relationships. Eventually, as you're getting ready to raise, you start negotiating these terms. You get a term sheet. You sign the term sheet. Enter diligence. Now, maybe there is some preliminary diligence initially. They want to, understand at a high level, what the corporate structure is and kind of who has what. But, you really get in the nitty gritty. I talked about this before about data rooms, and then documentation process. I actually kind of mentioned some of this before. There's kind of 3 flavors. There's NVCA style, which is probably the most common. Series seed style, which used to be super common, but probably seeing it like in, 5% of the deals that I'm doing these days. And then there are proprietary forms. It used to be there was like no standard, and there is kind of no standard. Each of these, even the NVCA forms and the series seed forms, get negotiated and tweaked. So don't let, on either side, don't let anyone tell you there's like standard. Then you get into the closing process. So that's actually when the stock gets sold and the money gets put in. And then there are post-closing items like securities filings and other things like that you got to run through and do, and notices. And then sometimes there are other deliverables. They want you to look into some regulatory issue and get feedback from your counsel. So that is pretty much everything you need. Well, not everything, but that's kind of the crux of what you need from a legal perspective to get your company positioned to get into a venture capital financing. All this is at a super high level. I'm gonna pivot, or I'm not gonna pivot, but I'm gonna talk about some common pitfalls, and I think we can transition into taking any additional questions that you might have. Let me just take a drink of water here, if you don't mind. So, common pitfalls, there's just non-compliance with securities laws. Subset of that is finders. Basically, finders are folks who will tell you they'll raise you money, but they're not registered broker dealers, and they very, very rarely fit into some sort of exemption from those laws. And as a result of that, violation of securities laws can usually result in a right of rescission. That is the right of the investor to get their money back. Most of the time, if the company's doing great and the company's more valuable, it can get cleaned up. The money doesn't, investors will choose not to get their money back. If the company is not doing so well, and the company doesn't have the money to pay it back, you're kind of up the creek, and it can be company killing. Got to pay attention to those regulatory issues. If you got a model that just doesn't work from a regulatory perspective, take, for example, certain kinds of companies in the healthcare space, right? Like where you need to have a physician operated entity. Well, you need to know that, and you either need to be able to fit into that scheme, and there are that regulatory scheme, and there are models to deal with that, or if you really can't make it work and it's not going to work from an economics perspective, the investors will be sniffing that out. Not managing your cap table. So we're talking about properly documenting who the owners are. So things like napkin promises, Yeah, napkin promises are kind of what a term of art for lawyers, which just basically mean, I mean, sometimes they are on napkins, right? You go out to dinner with somebody and say, I'll give you 20% of the company, and you write it down on the napkin. But, more often it's statements or emails, and it's just not properly documented. Thinking there are standard terms. Again, I think hopefully I've hammered home that there's usually a continuum of what is standard, and there's not just this is it, one size fits all. Talked about finders and how they fit into compliance with securities laws. Side letters. Side letters are agreements that you negotiate typically with your investors that are outside of the deal documents, whether they are convertible notes and safes, or whether they are in connection with the venture round. They cover things like pro rata rights. So those are rights of the investor to purchase additional shares of securities in future rounds. Why would investors want that, you might ask? Well, again, they're building a portfolio. One of the ways they deal with risk is not giving you all the money that they possibly could, and they want to see how you do. And if you hit those milestones, then they'll invest in the next round. So they are betting, or not betting, but that's part of the model, is that they'll want to have that. And the problem sometimes with having everybody have sufficient, or with everybody having pro rata rights, is there might not be enough room in the next round so that the current holders, especially the founders and employees, don't take too much dilution. And yeah, so you got to manage that. Other things inside letters, information rights, board observer rights. If you're dealing with the strategic, sometimes there's a commercial aspect to it. Failure to obtain proper corporate authorization. So, board consents, board approval, stockholder approval as applicable. If you don't do that, you're going to be spending more time and money on cleanup. And again, if you can't get sort of the requisite constituencies to agree to that, it could kill the deal. Vesting agreements. Again, you're going to need to have vesting agreements for sophisticated angels and or venture investors. If you are fully vested, they may make you revest some or all of it. If it's more than a single founder, generally speaking, like if it's a single founder, you may or may not need to get vesting agreements in place right from the get-go. But if you got more than one founder, then you probably do, because you don't want your co-founder leaving. Now, it might seem like they would never leave, but statistically, if you got 3 founders, one is going to leave within a year, something like that. That's what I've seen and read. I can't point you to, I can't give you a site on that at the moment, but that's very common. 83B elections deal with a tax issue in connection with purchasing stock that is subject to vesting. Those need to be, if you're going to file them, in almost all circumstances, you're going to want to file them. They got to get filed within 30 days, or else you've got a problem, a potential tax problem. And those are difficult to cure. Not paying attention to securities laws. It's down there again, because it's just so darn important. Again, most of the time, we're not talking about somebody who's a founder who's trying to defraud investors. I mean, those people could end up going to jail. We're talking about just not complying with them, which could result in a right of rescission. At least here in the US, and you got to check your local counsel for, whatever, if you're outside the US, what the frame is. But in the US, the SEC, the Securities and Exchange Commission, is the federal level that has the regulatory scheme on this. And then each state has their own. You got to pay attention on both. Most of the time, there are exemptions, but many times those exemptions turn on things like if you've got accredited investors in there. And common accredited investors are individuals or couples making either $200,000 or $300,000 more, or they've got $1 million in assets, excluding their house. Those types of things. Very important. Employment law issues, risk of that is misclassifying folks as contractors, and even though they should be employees. Many at the early stage, things have I'm trying to phrase this correctly. In the early stage, investors are not expecting perfection, okay? But they will expect that you're attuned to an issue and there's sort of a plan or a path to clean it or to address it moving forward to sort of mitigate the risk. Now, they may not agree with your plan, and so you may work on a plan together, but they will be expecting that you're aware of these types of things. Undocumented stakes in the company, IP that resides in other entities or individuals, and other tax issues. So, if you're a company that's selling products, you may need to be collecting sales tax, or your company that's a SaaS company, you may even have some sales tax on that you need to collect. And that's a potential risk. And I know investors look at that because you have to give a representation that, you've paid all of your taxes. So you got to bring in tax help on that. That's the rep is usually more in a venture financing context than a safer convertible note context, but being aware of these things is critical. So with that in mind, we've reached past the hour mark. I'm happy to take questions, any additional questions or comments. Otherwise, I guess I'll give you sort of one more plug if you think this content is helpful and you want to sort of view it on a, let's see, you want to view it, or you want to view similar content at your own leisure, on demand. I'm doing a sort of limited test run at the moment of the Venture Capital Training Camp, so you can check that out and register if you'd like. All right, we got some more questions. Are these pitfalls mostly by lawyers, and do we have them write these out? So I understand that question to be like, is this really just a lawyer issue that the lawyers have to address and handle? And the answer is usually there are business decisions, like I want to classify all these people as contractors because then I don't have, I don't have to withhold tax for them. And they like that because they get to take more money home and they're actually probably not declaring the tax, something like that, which is a problem. Or they're not paying the tax, or they're not declaring all of their income or something along those lines. So it's usually sort of business-driven issues that you got to work through with your lawyers. Lawyers are not omniscient. They can't look and see and know what exactly the company is doing without the company giving them the info and data. So working with your counsel to sort of identify the issues, like your practices, and then understand the risk that you face. That's kind of how this gets worked out. And then, usually, it might very well be, I don't know, the founders have not taken a salary initially. Well, theoretically, they're probably employees, especially if they're full-time, they're probably employees and they should at least be getting minimum wage. But many times there's a business decision. Look, we're kind of all in on this thing. The only people who are going to tell on us are going to be ourselves. The risk is pretty low. But, at some point, you're going to want to take a salary, right? You're going to want to get that cleaned up and you'll want to get proper compensation agreements in place with those folks. So that's how it gets addressed. Hopefully that answered your question. All right, I'm going to take another drink of water and then we'll see if there are any other questions. And if not, I will sign off. Okay, well, thank you very much for your time today. I want to thank Idea to IPO. I want to thank my firm, K&L Gates, for helping to organize all of this in conjunction with Idea to IPO. I hope you found today's discussion very helpful. Again, I keep office hours, and my name is Jason Putnam Gordon. All right, we got one other question. We got a couple more. If my company fits your funding model, that is, we require $1 million to $10 million to get off the ground and can generate $100 million by year 2 and project. Okay, so there is a question about connections with VCs, and I'm always trying to connect people But I would never, ever say that work with me or hire me because I'm going to connect you to money for two reasons. Because one, and I don't think you should trust any lawyer who does that, because one, they may not be able to do that and may not be able to successfully do that. And then two, at least from my perspective, one of the reasons why VCs will take my calls and take my suggestions and meet with people is because they're using me sort of as a proxy to sort of feel out, well, like, how's this team work? How's their product? Are they legit or full of BS? And it takes some time to work with a client to, build that mutual trust on both sides. So that's how I typically answer that question. And there's a question about what if you have any issues with VCs. I'm not sure what that is getting towards. I guess if you're having a dispute with your VC after it's closed, after a deal has closed, you usually try and work that out. And if necessary, unfortunately, the litigators have to get involved. And I used to litigate, but I'm very happy to not do that anymore. All right, so I will hold open the line for about 20 more seconds, and then I'll do a real sign off. Got my timer up so I don't shortchange anybody here. I hope you all have a wonderful weekend. For those of you who go out there and celebrate and have fun on not Thanksgiving, but Halloween, I hope you enjoy Halloween. And with that in mind, we'll do the sign off one other time. Thank you for attending today. I want to thank Idea to IPO and my firm for working together to organize today's event. Today's event was how to position your company for a venture capital financing. I'm Jason Putnam Gordon. My email address is jason.gordon@klgates.com if you want to reach out. I do keep office hours. And with that in mind, I'll give you the rest of your day back, and I'll let you get back to building your great company. Thanks a lot. Take care.